All right, so today, as I said, we're going to focus on Lecture 2, and as part of Lecture 2, we are going to discuss sort of the process for valuation that we're going to be following, and as part of the process, we're going to talk about the economic statement conversion. So I'll start out with this slide, which will go through, as I said, the process that we're going to follow this semester. So when we do a valuation of a company, the first thing we're going to do is we're going to try and understand the past in order to help us predict the future. So that's where we're going to start out with the historical financial performance. And essentially, the additional step that we're going to do is we're going to convert the financial statements from an accounting format to an economic format that ties into Modigliani-Miller, and that will make it easier for us to do the forecasting. So, step one, analyze and convert the historical, actually probably convert and then analyze the historical financials. Step two, forecast, right? So then we'll then talk about next week how to forecast financial statements. And what we'll do is we'll forecast two primary periods. A year-by-year forecast period, or individually forecasting out financial statements, and then what we're going to call a continuing value period, which says it's too hard to continue forecasting year by year, so we'll forecast a proxy for the long term, which is called the continuing value period. Okay? And then we will discount those cash flows back to today using a cost of capital, and that will essentially get us an operating value, which we'll add the non-operating assets to get an enterprise value. And then we'll talk about how to go from enterprise value to share price. So we'll talk about how we subtract out all of the non-common equity obligations to get to an equity value. Equity value divided by shares equals share price. It's actually a relatively straightforward process. And then we'll try and make sense of it and then do some iterative analysis so we can get a better understanding of what the valuation is telling us about a company. So that's the relatively straightforward process that we're going to be covering over the next few classes. But as I said today, we're going to start out with analyzing historical performance. Now, the book talks about several different models for valuation. And what's important for us to understand is no matter what model we choose to value a company using, we have to get the same answer. So a company's value shouldn't change because we took a different approach. Like there's one value for the company, and we all have to get to that same value. And so what you also have to understand is most of the financial models for valuing companies that are taught in business school are just rearranged equations. Right? And so they give you different insights into a company, but they shouldn't give you different answers for the company. And so to prove that out, this semester, the shortened semester, we're going to focus on two methodologies. We're going to do the discounted cash flow, or enterprise DCF as it's called, as one valuation methodology. And then we're going to do a second methodology known as the discounted economic profit or spread methodology, or EVA method of valuation. So that's what you're going to have to understand. That's what's going to be on your final exam, and that's what the valuations you're going to do on your group project. You'll do two valuations, and you have to come up with the same answer using both approaches. Now, again, there are other approaches that we could have taken, but considering that we have a very shortened period of time here to do everything, we're just going to focus on these two. But I will mention, at least conceptually, the difference in some of these other models. So again, the method that we're going to focus on for this class and starting this week is enterprise DCF. It's a valuation methodology based on the concept of free cash flow, right? And essentially, we forecast free cash flows, which we will discount at a weighted average cost of capital, and essentially just add it up. And really, if you think about it, it's just a net present value based approach. So the reason why DCF is used is DCF is based on NPV. And it will seem a lot like doing an NPV because that's really what it is. And the reason why it's used probably the most of any of the models out there, is about 90% of your valuations or cash flow valuations are going to be the DCF, is just because the finance people understand NPV, and so therefore it's easy to apply to a company setting. And it's also very flexible. So for example, one of the advantages of a discounted cash flow is I can value multiple business units of a company independently, and then I can add them together to get an overall value of the company. So NPV gives us the most flexibility, which is the other reason why DCF is the most commonly utilized approach. The second methodology that we're going to talk about is the discounted economic profit. Economic profit, also known as EVA or economic value added, is about the one period change in value of an asset. Okay? That's specifically what economic profit tells you. How much in a period of time the value goes up or the value goes down. So what we're going to do is we're going to start with the capital the company has invested, and then we're going to forecast the change in value over time. And when you take the change in value and you add it to the original assets invested, you get the value of the company. So again, you get the same answer, but you get a slightly different insight, because with the discounted economic profit model, what it really tells you is, are you adding value to what was spent, or are you taking away value from what was spent? And that is a concept known as market value added, or MVA. So it's the difference between the market value and the book value. So essentially, economic profit explains that difference, right? Are you creating value? Then you're generating economic profit. Are you destroying value? Then you have negative economic profit. And so economic profit tells us if we've created or destroyed value. So we get to the same answer as a DCF. The difference is, in the economic profit methodology, we can see whether we've added or created value. In the DCF, we just see the total value that we've created, okay, or the total value of the business. So it just gives us an additional level of granularity. Now, a third method for valuation that we're not going to talk about this semester other than right here is something called APV. It stands for Adjusted Present Value. And generally, since it gives you the same answer, it's a lot of work. And since you're getting the same answer as the DCF, most people don't do it unless you have a specialized need. So here's the key to APV. What APV does is it helps value the capital structure of the firm and applies it to the operating part of the firm regardless of capital structure. So basically what APV does is it tells you the value of a company's capital structure in using debt and how much value is created by applying the interest tax shields of the debt to a firm. So here's the point. One of the underlying assumptions of DCF is that a company will maintain a target capital structure. That's implicit in the enterprise DCF and the discounted economic profit methodologies. So the debt and equity doesn't really change over time. If, and by the way, that's why we use the weighted average cost of capital, right? Because we can use one weighted average cost of capital for the entire valuation because we're assuming that the capital structure is not changing. Right? But if the capital structure does change over time, so we go from 80% equity to 20% equity and 20% debt to 80% debt, then it will influence that cost of capital, right? So the point is APV allows us to value the company and value the capital structure independently. So if the capital structure is not changing, APV doesn't really give you any insight into the firm. If the capital structure is changing, then APV tells you what happens as a result of the capital structure. So the people that would use APV would be, for example, a private equity firm. So I take somebody private and I load them up with debt as part of a leverage buyout. Well, in that case, the capital structure is going to change dramatically, and there is a cash savings to loading up with debt because of the tax deductibility of the interest. So it makes sense to do an APV to basically do a simulation to say, does the savings from the tax deductibility of interest with the interest tax shield offset the additional financial risk associated with adding more debt to our firm? And so what they'll try and do is see if there's an arbitrage opportunity where the market isn't as efficient as we might think it is, and they can exploit taking on more debt, and the market doesn't essentially price the debt effectively, and so therefore they can take advantage of that. So that's where APV is actually used. Or the opposite. I take a company public once they've been private, and by going public, I raise a lot of equity, and I use the equity to extinguish the debt. Right? Because even when a company does like an IPO for the first time, I might even be venture backed. And the venture people lent me a bunch of debt, and as part of the IPO, they're going to pay off those original investments. So the end result is whether it's preferred that it gets paid off, or debt that gets paid off, or convertible that gets paid off, I'm going to replace it with common. So again, I can look at the impact of the APV on that transaction. So again, capital structure changes, makes sense to use APV. Capital structure doesn't change, APV is a lot of work that gets you the same answer as the enterprise DCF. Model number 4, capital cash flows. So the book talks about this, and this, of all the financial valuation models, is the least used in the real world. As a matter of fact, in 20 years of working in the financial industry, I've never seen it used outside of a classroom. Okay? So the capital cash flow model is more of an academic model. And what it does is that it basically says that a lot of the time we're going to spend today is taking the cash flows of a company and splitting them out into multiple buckets. Operating cash flows versus non-operating cash flows. That's going to be one of the key things that we're going to do, and then we're going to strip out the debt cash flows from those cash flows. So we're going to take the cash flows and we're going to split them into the 3 components, and we're going to value the components independently, because that will give us more insight into what the firm does. And what the capital cash flow model basically says is if you don't split the cash flows in those 3 buckets, and you just treat the cash flows as one big blob of cash, and you value that blob of cash, you get the same answer as if you broke it into 3 parts, valued the 3 parts separately, and added them together. Okay? So I'm sure that was a great PhD thesis paper, but the practicality in the real world is that lumping all the cash flows together is just not as insightful as breaking them into its component parts. That's why in the real world people don't use the capital cash flow method. But if you leave all the cash flows together as splitting them apart and you value them, you do get the same answer. That's the capital cash flow method. The final method is known as the equity cash flow method. We don't have time to deal with this, but basically the equity cash flow method is used to value banks and financial services firms. There's actually a chapter late in the book about talking about how to value banks, and they introduced the equity cash flow method. And here's the primary difference, which is free cash flow is the cash to the debt and the equity holders, and the weighted average cost of capital is the cost of the capital of the debt and the equity. Equity cash flow is just the cash flow to the equity holders. And the valuation is then discounted at a cost of equity, which is just the expectation of the shareholders. So the point is, I can value the company based on looking at my NOPLAT or NOPAT, and then essentially get free cash flow, and then discount at a WACC, so return on the debt and the equity, return the invested capital. Or I can value the company based on net income, which subtracts the debt, and then just looks at the cash flow to the shareholders, and then calculate a return on equity, and then discount it against the cost of the equity. I should get the same answer, right? The only difference is what I'm rearranging is in the equity method, just the equity flows. In the free cash flow method, the flows to the debt and the equity. And you might say, well, why do we do it differently? And the answer is, we prefer in finance the free cash flow method because what we want to know is how good is the business regardless of how it's financed. Whereas if we do the equity method, the finance is mixed in to the cash flow before we get the returns to the shareholders, because it's going to include the interest as well as the operating performance. Whereas in the free cash flow method, it's basically taking out both the interest and the dividend, the equity, and then just looking at the performance of the business. So as I said, just rearranging the cash flows, you get the same answer. But here's the reason why we do it differently for banks. For banks, interest isn't just financing. So for example, a bank makes a loan to you. Well, that is interest income to the bank. And then the bank has to raise cash to fund the loan. That's the cost of goods sold for a bank. That's called interest expense. So a bank generates net interest margin, which is kind of like gross margin for a bank. All of that to a bank is operating, right? So for a bank, interest is operating. For a manufacturing company, interest is financing, right? So it's really interest that becomes the challenge with a bank. So it's not really clear whether interest is operating. And here's the other thing. Banks also will issue debt to help fund the bank long term. So that debt is financing. So the problem with a bank is when banks have interest, we don't really know whether that interest is operating or non-operating, and it's harder to classify. And especially if you're an external person, it's hard to keep track of, well, this interest expense is operating and this interest expense is non-operating. And even within the bank, it gets very complicated because these funds get intermingled. So what you basically do is you say, I'm not going to worry about whether it's operating or non-operating, and therefore what I'm just going to do is I'm going to treat it all like an equity cash flow. So it might be financing and it might be operating, and I can't tell the difference. So therefore, I'm just going to leave it all together and then figure out the cash flow to the shareholders. That's why we do it that way for banks and insurance companies. But for everybody else, where it's easy to say debt, you know what, that's just long-term financing for a business. We're going to strip out the debt and the equity financing separately from the enterprise value, the operating, non-operating. That's enterprise DCF. Does that make sense? Okay. So as I said, that's what I wanted you to just kind of know about some of those other models. We are going to focus on the first two. But again, if I'd used any of the same models, any of those 5 models, I should come up with the same answer. Okay. So, continuing on. Yes?
It's supposed to be projected.
Oh. Sorry. I thought I was...